Let's talk about the regulation of commercial banking. Because commercial banks are essential to the creation of money, the government regulates them to ensure sound and competitive financial system. We'll see how the Federal Reserve System regulates many aspects of the US banking. Other federal and state agencies also regulate banks to ensure that the failure of some banks as a result of competition will not cause the public to lose faith in the banking system itself. Federal Deposit Insurance Corporations. While the Federal Deposit Insurance Corporation FDIC insures deposits in member banks, more than 99% of the nation's commercial banks pay fees for membership in FDIC. In return, the FDIC guarantees through its bank insurance BIF the safety of all deposits up to the current maximum $100,000. If a bank collapses, the FDIC promises to pay its depositors through the BIF for the losses up to $100,000 per account. A handful of the nation's 8,000 commercial banks are insured by states rather than the BIF. To ensure against the multiple bank failures, the FDIC maintains the right to examine the activities and the accounts of all member banks. Such regulations are effective from 1941 through 1980. When fewer than 10 banks failed per year, in the beginning of 1980s, however, the banks were deregulated and between 1980s and 1990s, losses from nearly 1,100 bank failure depleted FDIC's reserve funds. In recent years, the FDIC has thus raised premium charge to the member banks to keep up the losses incurred by the failed banks. Next, we talk about the Federal Reserve System. Well, if we talk about the Federal Reserve System, the perched atop the US financial system and the regulating many aspects of its operations, the Federal Reserve System, established by Congress in 1913, the Federal Reserve System, we usually call it the Fed, is nation's central bank in this study, so to say, and we describe the structure of Fed and its functions as the tools that it uses to control the nation's money supply. What is the structure of the Fed? Fed means the Federal Reserve System. The Federal Reserve System consists of a board of governors, a group of reserve banks, member banks. As originally established by the Federal Reserve Act of 1913, the system consisted of 12 relatively autonomous banks and seven members committee whose powers are limited to coordinating the activities of those banks. By the 1930s, however, both the structure and the functions of the Fed had changed dramatically. The Board of Governors. The Fed's Board of Governors consists of seven members appointed by the President for overlapping terms of 14 years. The chair of the board serves on major economic and advisory committees and works actively with administration to formulate economic policy. The board plays a large role in controlling the money supply. It alone determines the reserve requirements within statutory limits for depository institutions. It also works with other members of the Federal Reserve System to set discount rates and handle the Fed's sales and purchase of the government securities. Reserve banks. The Federal Reserve System consists of 12 administrative areas and 12 banks. Each Federal Reserve Bank holds reserve deposits from the set of discount rate of the commercial banks in this region. Reserve banks also play a major role in nations' check clearance process.